You are listening to another episode of the Mortgage Impact Podcast. I'm Jen Bates, the Communications Manager for Movement Mortgage. This week, another episode of On Deck with Barry Habib, the founder of MBS Highway. So if you're not in mortgages, you're not in the finance world, you're not entirely sure what MBS stands for. If you are in mortgages, you might know MBS means mortgage-backed securities, but you may not know how they work or how they affect interest rates. And guys, that is super important. And Barry Habib is an expert, and he makes it incredibly easy to understand. Now, if you're not part of MBS Highway, you will not really understand a small part of this. About halfway through, Barry does a screen share on Zoom and where he shows off some of the features of MBS Highway and following the markets. So if it's a little bit hard to follow along at that point, totally get it. But Barry's advice throughout there is still very accurate, on point, and easy to follow. A lot of great information in this one. Ryan Hill's leading the conversation. He's one of our loan officers at Movement Mortgage. Jake Failing also on the call. So listen in and enjoy.
Hey everybody, I'm Jake Failing and welcome back to another episode of On Deck with Barry Habib. And I am once again joined, I shouldn't even say joined, Ryan's going to quickly take this over. Ryan Hills, market leader for Movement Mortgage and host of the RE Source. Ryan, today we are talking about, we made this a nicer headline, right? We were going to say MBS for dummies. We didn't want it. I just said it. Instead we went with MBS for newbies. So if you could, with Barry helping guide the way as he does, Ryan, could you help us answer some of these burning questions?
For sure, man. I'm excited about this segment because I've been watching Barry for years, and I know that I'm going to learn a lot asking these questions. So Barry, first of all, thanks for being with us, man. Congrats on all the success with Money in the Streets. Just pre-sale. Sounds like it's already #1. Is that true? Amazon?
Yeah, I couldn't believe it. Over the weekend, I got the notification Amazon said you're now #1 bestseller on Amazon. I was like, oh my gosh. Actually, I said something different than that, but we won't say that here. But first of all, really not for newbies, really it's for everybody because so few people understand some of the technicals, and they're so valuable, not just for MBS, for everything, your own stock trades, your portfolio, your own wealth creation. And you know what? I do have to take my hat off to Jen Bates, who does so much here and really was so patient in trying to get this together. So we are thrilled that you're on this because Jen's behind the scenes doing all this stuff and coordinating it. So I'm really glad that you're on, Jen.
Thank you, Barry.
Learning in CMA.
And she's going through the CMA course. That's right, Certified Mortgage Advisor, and she's digging it. She was hitting me with all kinds of good stuff, man. Look at you.
I'm just trying to keep up, okay? I got to be like intelligent about these questions and try to make sure we have everything on board. So I'm ready to learn here.
Yeah, and thanks for throwing me under the bus earlier, Jen. She's like, hey, Jake, just curious, have you taken the MBS portion of the CMA course yet before this podcast? I said, sorry, I'm breaking up.
He blamed Zoom, I think was the answer. He blamed Zoom. So
feel free to sneak in any questions, Jen. Okay. So Barry, we'll start with a softball. Okay. And it is for newbies and we'll progress from there, but let's start with a softball and you can take control of the screen. But like all of the squiggly lines that actually mattered today, what is that about? All of these, they're different colors, they move. They seem to bounce off of it. Like, I don't understand. Like, what are those squiggly lines for? Why does it matter?
So technical analysis, this really changed my life when I learned it. I was very blessed. Two gentlemen, a guy by the name of Jack Grummett first introduced me to technical analysis. And once he showed this to me, I was a young guy. I was like, oh my God, this is like having tomorrow's newspaper. He says, now calm down. He says, it doesn't always work, but you really do have an edge. And then the other guy is the guy that brought Japanese candlesticks to the United States, a guy by the name of Steve Nissen. When I went to attend one of his seminars, we started talking. You know, I'm a young guy. He kind of said, maybe I'll help this guy out. I seemed eager. And this is the guy that brought Japanese candlesticks to the US. He happened to live 15 minutes from me. So we became friends and he really mentored me on understanding it. So, you know, listen, it was very fortuitous for me, but it was truly life-changing. And I think it's life-changing for anyone who understands this because the markets are driven by emotion. You can't see emotion. It's all here. If you look at somebody's face, you can see their emotion, but of all the other market participants, those who are buying, those who are selling, you can't see their emotion. Well, these ingenious patterns allow you to quantify the emotion of the market and see exactly what's happening. And then because so many people that are managing money are looking at the same things, it becomes a self-fulfilling prophecy because then they set their computers to do the automatic trading at these levels that this is a time to sell, this is a time to buy. And when they do that, what occurs is that the multitude of those orders being put in causes movement in that particular security, whether it's a mortgage bond, whether it's your favorite stock that you've been watching. You can really gain a tremendous advantage of knowing I should wait and buy here, or this is possibly a good time to sell. Because what we kind of look at here are two things. We look at ceilings and floors. So there are patterns that develop from ceilings and from floors. And a lot of this is all in the CMA course. But listen, let me give you just a quick example. Let's just say that, Ryan, you came in and you're in the office with a few of your movement teammates, and Jen and Jake, and you said, listen, I really have a great feeling about this stock. I've been seeing some great things happen with the company, and all legally and whatever, you kind of see that this company is doing great and you think it's a good buying opportunity. And I kind of say, well, no, I'm not so sure. I kind of sit on the sidelines. Well, let's just say that stock's at 40, and all of a sudden, wouldn't you know it, Jen gets in, Jake gets in, and you guys every day you're high-fiving because it's 43, 45, 48. It gets to 50. I'm on the sidelines. I can't take it anymore. So I say, okay, guys, I'm in with you. The second I get in at 50, what happens? The thing starts to move lower. Now, as it heads lower, lower, and lower, I'm like, oh no, what did I do? I feel awful. I saw it go from 50 all the way back down to 40. I'm like, man, I'm like a deer in the headlights. But then suddenly it starts to come back. 42, 45, 48, 49. It approaches 50. What do you think my inclination is to do as I now can exit this thing and break even unscathed? What will I likely do? I'll likely sell. Because at that point in time, I feel like, hey, I got even, I averted disaster. I now feel like I'm safe. But I wasn't the only one who bought at 50. All those other people that bought at 50 watched it go all the way down to 40. As it approaches 50, they say, let's all get out. And the act of all of us selling causes it to drop again. That's a technical pattern called a double top. And these are things, this is emotional. And this is just an example. The moving averages, just take the closing price and show it over a period of time, 25 days, 50 days, 100 days, 200 days. And the reason why we look at those is because everyone else is looking at the same things. And as you approach a 25-day or 100-day moving average as a ceiling, there's a propensity to hit that ceiling and drop lower, because programmers in the market look at those ceilings and say, that's a good level to sell at. The same thing is if those moving averages were underneath you, they'll say, this is a cheap price. This is a time to buy. Or in that example we gave, hey, the last time it hit 40, it started to move higher. So next time it goes to 40, guess what I'm going to be doing? I'm going to be buying. And the act of all those programs coming to be causes it to move up. So what we try to do is look at that for mortgage-backed securities specifically, and the yield on the 10-year Treasury, so that we're better able to gauge. And if you wanted to see some of it in action, it's really pretty incredible how it works. And first, we'll take a couple of other questions real quick, and then I'll show you in real life how this actually works for us.
Yeah, because they held today. So the squiggly lines are moving day averages. There was 2 today. They acted as a ceiling of resistance, and so they actually matter. And if Barry will probably pull it up later, or you can do it on your own login. You'll see those moving day averages, and you'll see that MBS has hit them, and we're waiting to see if they bounce through or if that ceiling continues to hold. So let me ask you kind of another softer question. It's more not so much about MBSs, but lock versus float. So there's this old myth in the mortgage industry, and I want to know if there's any truth to it, but you never lock on a Friday. Like, it's science. It's just science. You never lock on a Friday, Ryan.
No, it's ridiculous.
That's all a bunch of malarkey.
So let's just dispel a lot of things. So rates don't go down necessarily in an election year, okay? Mortgage rates and the Fed funds rate, 2 totally different things. 10-year and mortgage rates, 2 totally different things. Each trade independently. And some people will say, oh, I lock everything. Stupidest thing you could possibly do. Because what did you just do? Buried your back office, pissed off your customer, and put yourself in a terrible position, because sometimes rates improve. Listen, here's the fact of the matter, is you're forced to gamble. Client, you're forced to gamble. Locking is a gamble. Locking is saying, I think rates are going up. Floating is saying, I think rates are going down. There is no choice in the matter. It is red or black, okay? It is odd or even. It is lock or float. Either one is taking a position to gamble. Locking all your loans, worst thing you could have possibly done for most of 2020 and a lot of 2019. And you would have gotten buried, and you would have had all kinds of concessions, pissed off customers, customers leaving you, pricing exceptions. Floating everything is the stupidest thing you could do too. What you have to do is you have to watch the market. You have to be able to interpret it and understand it and make good, educated suggestions that your client buys into and sees the logic. Just like a really good advisor in debt, in assets would do for their customer. Nothing's going to be 100%. You explain that, but you say these are the risks and these are the rewards. And when you look at the technical signals, you can say, well, we're a lot closer to a ceiling, so therefore there's not that much to gain, but there's a whole lot we could lose. Yep. So maybe we protect that. Maybe this is a good time to lock because, boy, we could lose a lot of pricing. Or the opposite could be, hey, you know what? We're bouncing off this floor. Probably a bad thing to lock. How many people have locked in only to see pricing get much better right after they lock in? You know, these are the things we want to be able to make educated suggestions that our customers agree with, or at least are given the opinion. Customer does what they want. We ultimately have no choice in the matter. Customer does what they want, but we want to be an advisor. Look, if we turn everything on autopilot, fintech is going to take over, right?
Great point.
Then the headset jockeys win. Okay, all we have is our advice. All we have is our knowledge, because we're never going to have the lowest rates. Nobody does, right? We want to be able to make that customer feel as if they can learn something from us, but you can't give what you don't have, right? So we have to kind of make sure that we become students hey, look, I'm a student every day. I don't consider myself I consider myself a student every day.
So no truth to lock, never lock on a Friday. Quickly dispelled that. I appreciate that. If I'm a newbie, and this is actually, I have producers, and I'm sure they're more than just on my team across the nation, that do 50, 60, 75 million, and they have never truly learned to watch MBSs, which is crazy to me, but they're still successful. So if I were to start now and I pull it up and I got moving day averages, I got Jenny's coupon, the 10-year, Fannie's coupon, that's a lot of information for a newbie. So if I were to distill that down to maybe 1, 2, or 3, like just start with these 3 factors, like what would those 1, 2, or 3 things be? Because there's a propensity to get overwhelmed real quick looking at that.
So here you go. So first of all, look, 50 million is great, right? But who knows? Maybe if you were more of an advisor, it would be 100 or 150 million, right? I mean, so everything is relative, right? How much more would you be able to do? How much better of an impact on those customers? What would the word of mouth be from those customers in level of satisfaction? What would the insulation be against a fintech company if you created that kind of experience? And remember, that's what we have to do. Transactional is one thing, but experiential is what we should always strive for. And the way to do that is to truly be an advisor. Now, let's take a look at some of these things, as you mentioned, because you said, what's a couple of things that we want to understand? Well, let's take a look. I'm going to pull up my screen here, and we'll do this just basically now today we did do an alert to lock, and I'll show you why. First of all, these are Japanese candlesticks. They each represent 1 day's trading. For the most part, a red candle means a down day, a green candle means an up day. That doesn't always happen that way. The color of the candle is based upon the difference between the opening price and the closing price. But to keep it simple today, let's just say red is a down day in pricing, means worse pricing. Green is an up day in pricing, can mean better pricing. The thick part of the candle is the difference between the open and the close, and the wicks, which extend beyond the body sometimes, will give you the upper end of where it traded and the lower end of where it traded each day. These all give us clues on the emotion of the market. We're not going to get into that today. What we're going to do is we're going to talk about ceilings and floors. So notice here this black line. This is the 50-day moving average. Now notice how this acts as a floor. Prices come down, down, down. Where do they stop? Dead on the 50. It's no coincidence. Stops again there. Moves up, stops on the 25, comes down, stops on the 50, stops on the 50, stops on the 50, stops on the 50. Now, eventually, after pounding away at it, it got squeezed between this 25-day moving average, and you can see ceiling, and this 50-day floor. It kept getting squeezed, 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 squeezed. Something had to give. It gave to the downside, and then notice how what used to be the floor, what does it become? The ceiling. It's called the rule of polarity. Now, eventually, based upon news, we break above it, and then we have a new range, new ceiling, and this becomes the floor. And this is in effect for a couple of weeks. Now, what happens is once you break underneath it, this now becomes the new ceiling. And notice how 1, 2, 3, 4, 5, 6, 7 attempts to break the ceiling, We could not break the ceiling, and therefore now you're seeing it give a little bit of ground. And that's why we issued an alert to lock, because we felt that we were going to lose a little bit of pricing. Now, we look at the next floor. That's here. So I think we're going to get down to this floor right here and probably have a moment of truth. Will we be able to hold this floor, or will it bounce off of this floor and move higher? Now, one of the other things is, let's take a look at the 10-year Treasury, because this is an important area that we're in right now. This top here, remember that double top? That was at 0.78. And you heard me, if you watch our updates, talk about this. And sure enough, we said, hey, it's going to go back up to 0.78. It did 1, 2, 3, 4, 5, 6 days in a row. Why is it magically not breaking this level? Well, because this is a ceiling now, and all the traders are acting that way. It tried to break it. It couldn't. It went back down. And here we are. We made a run at it yesterday. Stopped dead at it. Now, today, something's changed. We've broken above it. That prompted this lock alert. Why? Because we are fearful now that when we look at the next ceiling, where is it, everybody? It's this moving average, the 200-day at 0.88. So we could lose a lot of pricing if the 10-year went from 0.78 to 0.88. Mortgage-backed securities might drop 40 or 50 basis points. And there is some fundamentals that we're looking at here. There's a potential stimulus package. If we get an announcement that the stimulus deal is done, bonds are already vulnerable. I think that the bond market would succumb and we'd see yields go up. And I think mortgage-backed securities get a little worse. But notice how this is just in a trading range. It's like a ping pong ball. If you have this, it's almost like having tomorrow's newspaper. You know, hey, it's going to come down here. I'm floating. I'm locking. You know, I'm sorry. In this, because this is in yield. This is a area where we're going to see yields rise. So in this particular case, we're going to be in a position where we think yields are going to go up from here. And this is where we think yields are going to come down. And it works beautifully. So I don't want to lock here. I want to be floating here. This is a good time to be locking right here. This is a good time to be floating. And now it normally would be a good time to be floating, which is why we give it the opportunity, but a break above here changes everything. That means if we close above this level, what used to be the ceiling, the worst that yields could be, would now be a floor and be the best that yields could be.
Guys, you can see why I asked that. My first question was the moving day average, and he's just showed you both on the 10 and the 30-year, basically why they matter and how they've coordinated trading. And Barry opened with, you know, when he first learned this, you can kind of predict tomorrow. It's not that hard. Even in the 10 minutes that we've been on here, you can go, oh yeah, it's probably going to bounce off that floor of support, or it's probably going to hit that ceiling of resistance. So that's why my first question matters, and you did a great job explaining that. Jake, how much time do we have? At least one more question, two more?
Yeah, I think we do have time for one more question. Let's be honest. I think we have all the questions. I think
Yes.
What would be important for us is, you know, Ryan, you talk about your 50, 60, $70 million producers. You know, I'd love to hear your perspective on someone who's maybe brand new in the industry, or someone who's doing about $1 million a month in volume. Where do they jump in this spectrum? You know, is MBS highway for them too, using a tool like that? Or I guess.
Well, yeah, Drake, you nailed it. You're 100% right, because listen, if you're at any stage, you want to be a better professional. If you're a big producer, then this is going to touch many more people and grow your business exponentially. But if you're a newbie and you understand the market, you're going to be able to win clients away from experienced people who don't understand this much more easily and grow your business much more rapidly. Look, this game, I'm going to take off the screen because I want to talk to you guys. Sales is about one thing. Relationships are about one thing, and that is trust. Trust is everything. It's trust like that in your personal relationships. It's like that with your family. You know, in your most intimate relationships, trust is everything. It's the same with your customers. There are two ways to build trust. Number one way is you build it with knowledge. You become magnetic when everybody you come into contact with feels they can learn from you and feels that you make them feel better about themselves. You become very magnetic. That's an important thing about building trust. So if you understand this, you can quickly build trust with your referral source or with your customer, because they'll be learning from you. And the other way to build trust is, believe it or not, by telling them everything bad. Tell them all the bad stuff. When your customer knows that you're willing to give them everything good and bad and not try to sell them, but really advise them, when you go from being across the table to being next to them with your arm around your shoulder and saying, hey, let's look at this together. When you treat your customer like your kid, your parent, your best friend, and you're saying, I'm looking out for you, and here's the things you should watch out for, changes the dynamic. But the other aspect is knowledge, and you have to acquire knowledge in order to dispense it.
we do a podcast with this afterwards, obviously audio only. For those of you that are only consuming this content that way, you just missed. I feel like Barry just he had glasses on. He leans back. He takes the glasses. He did the slow fold of the glasses, and he leans all the way in. And that's when you know it's serious, folks. That's when you know that an Amazon bestseller is giving you the goods. Ryan, can you do one more quick one? You got one more quick one before we wrap this MBS for newbies?
Yes, quick one, Barry. You can do it.
All right.
For sure. And here's the good news. Like, if we can talk Barry into it, it's clear because I'm getting text after text going, ask Barry this, ask Barry this. So maybe we can talk Barry into a deeper dive or a master class in the future because I have so much more to ask.
Wait a minute. I like it.
But one last question to wrap it up. You can do it quick. If you scroll back up to the 2% coupon, can you talk about why it's a 2% coupon versus the
yes?
rate?
Okay, I could do that without the screen share. So here we go. All right. So there's the mortgage circle of life. You know, it's not Lion King, but we have this in the mortgage business. Okay, and this is at the essence of the basics of the mortgage industry, which 99% of your competition doesn't know. Where does money come from? Where does mortgage money come from? You think proof is just, oh, I need a mortgage. Oh, it's going to rain dollars on top of this customer. Check shows up at closing. Where do you think the money comes from? The money comes from a cycle. So let's start off. Imagine a clock. Right at the top is the borrower. So the borrower wants a loan. Where do they go? They go to the originator. The originator then arranges for the financing, and they'll go to a company like Movement. So now a company like Movement is, in this particular case, the initial lender. But Movement can't hold on to the mortgage. Why? Because this is a hot potato. Let me explain it to you. Say if you were nice enough to give me a mortgage, and let's make it crazy. Let's say the mortgage is a 10 LTV, okay? Don't allow any seconds. I've got a perfect credit score. My ratios are less than 10. You would think, what an ideal customer, right? The risk isn't in repayment of the mortgage. The risk is in interest rate. Because if you gave me a rate of 3% on a $100,000 mortgage, you're getting $3,000 a year if it were simple interest. I'm making it simple. What if next year rates went to 6%? Is it still worth $100,000? The answer is no, because $100,000 is a 4-inch stack of $100 bills that I could do anything I want with. You are tethered to a 3% rate while everyone else is getting 6%. So if you wanted to value it, borrow against it, sell it, here's how you do the math. And again, this is overly simple.
Yep.
$3,000 a year. How much would I have to invest in a 6% market to get $3,000 a year? The answer is $50,000. So you have this great loan that pays you early, that's no risk of repayment, but you lost half your money. So everyone knows this, which is why nobody holds a fixed rate mortgage. So Movement then gives it to an aggregator, Fannie Mae, Freddie Mac. Now they're not dumb either, but what they're able to do is aggregate huge amounts of these mortgage-backed securities to put in big bundles that they then go to Wall Street and they say, we got this big bundle. And because it's so big, we want you to be able to offload it and sell it. Wall Street says we do that all the time. We're going to securitize it. We're going to turn it into a mortgage-backed security. And our sales team, they're going to sell it. Who in their right mind is going to buy this risky asset? Guess who? Look in the mirror. You and me. If you look in your 401ks, your IRAs, your mutual funds, loaded, Fannie, Freddie, Ginnie, mortgage-backed securities, it is ultimately the public who takes on the risk. That's why your returns are up 8% one year, down 6% the next. We take on the risk. So it's a whole circle of life. The same person borrowing it in some way is the same person lending it. Now, when we issue a rate, when the borrower pays 3% on their mortgage, the originator, the lender, the aggregator, Wall Street all take a piece. So what rate is left for the investor? 2%, which is why you look at that 2% coupon that's been securitized.
Love that.
Can I just say, I just had like a flashback to part of the CMA course, if nobody's involved, because it is pictured so beautifully. I was like, yeah, I pay for that. That's perfect. Love it.
So there you go, team. I mean, this is, it's important that you know this because your competition doesn't, and it's so simple. This is how you can explain why a jumbo costs more, because your customer says, you know what, in everything else, the more I buy, the cheaper it is. I'm buying a jumbo, that's more, shouldn't it be cheaper? No, you're buying less. Because in the bundle that's being sold from Fannie and Freddie with conforming loans, that's a much bigger bundle. So the fee that Wall Street assesses on each loan is incrementally less. A jumbo pool of loans, there's fewer of them. So when Wall Street assesses their fee to securitize, underwrite, and sell it, the incremental cost on each loan is greater, which is why a jumbo loan costs more. And nobody knows that.
Well, there you have it. The circle of life. I think there's some Lion King opportunities here, Jen, with like post production content. Okay. The Lion King himself. I don't know. Were we going to run with that, Barry? Barry
I don't know.
Habib.
Please don't do that.
No, we're not. Hey, it's moving. You never know with us with content, but we'll leave it alone. Barry, thank you so much for joining us once again. And Ryan Hills, my man, thank you for carrying me once again on these shows. We have Barry on. If you're just tuning in, we have Barry on once every couple weeks. Amazing content, quick hitting. Check out the podcast. Check it out. Check us out if you're at Movement, and tune in a couple more weeks when we have Barry back.
Love my movement peeps.
Thank you, Barry.
Bye, guys.